For decades, the index fund has been the ultimate wealth-building tool. It pools your money into a single, simple basket. You buy one share. You own a fraction of the world. But right now, a quiet migration is underway. $800 billion is moving. It is unbundling that basket to exploit the underlying mathematics of taxation. This is direct indexing, a structural shift in modern wealth management. It takes the passive index and turns it into an active, surgical machine. It is not about picking winning stocks. It is about controlling the mechanics of your wealth. Step 1. The capital routing. Your initial cash deposit enters the system. In the past, this money would buy a single share of a pooled fund. Your identity would dissolve into a massive, collective pool. Direct indexing changes the architecture. Your capital is routed into a separately managed account, an SMA. You now hold the actual assets under your own name. The rigid wrapper of the traditional mutual fund is gone. You own the foundation directly. The barrier between you and the market is removed. Step 2. The deconstruction. An algorithmic command enters the system. Its objective is to mirror a major market benchmark, like the S&P 500. The software fractionalizes your capital. It buys the individual underlying equities of the index in their exact market weights. You no longer own a proxy. You own a miniature, precise replica of the broader market. Hundreds of individual stocks sit in your account. The stage is now set for deep, mathematical customization. Step 3. The daily variance scan. Live stock market price feeds pour into the algorithm. The broader index might finish the day up 1%. It looks like a uniform victory. But beneath the surface, the market is chaotic. Dozens of individual companies inside that index will end the day in the red. The algorithm scans your portfolio. It flags localized drops. It separates the losers from the winners on a microscopic level. It finds the fractures in a rising market. Step 4. The strategic harvest. The flagged losing positions are isolated. The system surgically sells these underperforming stocks. This captures a realized capital loss on paper. In the architecture of wealth, a realized loss is a highly valuable asset. It is the foundational currency of tax optimization. You have extracted a tax asset from the market, and you have done it without altering your overall market trajectory. The loss is banked. Step 5. The correlated proxy swap. The cash from the sold losers cannot sit idle, and the tax code prevents you from buying the exact same stock back within 30 days. The system executes a precise maneuver. It instantly buys a highly correlated competitor. If it sells a dropping home improvement giant, it buys its closest rival. Your portfolio maintains its precise index tracking. The structural integrity of your market position remains intact, but you have successfully and legally banked the tax loss. Step 6. The customization filter. Your personal financial boundaries enter the algorithm. You might work in the technology sector. Your income and your company's stock already expose you to massive tech risk. The algorithm adapts. It strips out specific tech companies from your personal index. It prevents dangerous overconcentration. The index now bows to the reality of your life, bending to your career, your ethical preferences, and your risk tolerance. You are no longer forced into a one-size-fits-all product. Step 7. The tax alpha compound. A year of harvested losses meets your annual tax return. Those aggregated losses are deployed. They offset your other capital gains or your ordinary income. You owe less to the government. The taxes you did not pay remain invested in the market. They accelerate your compound interest curve. You generate tax alpha. This is an additional layer of yield created entirely from structural efficiency. It requires no extra risk. It is pure mathematical leverage, working quietly in the background.